computer on the Proshares website, looking at the ETF NOBL, NOBL, as in noble, as in aristocrat. So this is the Proshares S&P 500 Dividend Aristocrats ETF. If you don't know, the Dividend Aristocrats are a group of companies in the S&P 500. So you know they're big names, common household companies like McDonald's and Home Depot, big companies that's been around. And not only are they part of the S&P 500, but they've also been increasing their dividends for at least 25 consecutive years. So these are as solid as you get. So Proshares made an ETF using that as the screener. They have to be in the S&P 500 and they have to have raised their dividends for at least 25 years, meaning they're dividend aristocrat. Okay, so why? Why invest in Noble? Obviously, if you invest in just an S&P 500 like a VOO, you will have all 500 companies. The companies that pay dividends, the companies that don't pay dividends. But if you're focused on dividends, then this is something to consider. Not saying something to buy, but something to consider. So why invest in Noble? The only ETF focusing exclusively on the S&P 500 dividend aristocrats. So that's something. High quality companies, like we said, that have not just paid dividends but grown them for at least 25 consecutive years, with most doing so 40 years or more. So they have a track record of paying dividends. And one thing you want to look for when you're looking to build a dividend portfolio is a track record. You want to have faith that this dividends will continue, especially when I need them. They're often household names. Noble's holdings generally have had stable earnings, solid fundamentals, and strong histories of profit and growth. Noble's strategy has a demonstrated history of weathering market turbulence over time by capturing most of the gains of rising markets and fewer of the losses in falling markets. Let's look at, okay, so now we know what Noble is. Let's look at a little more about the fund. So the ticker is Noble, NOBL. The expense ratio is 0.35%, which, as you already know, for every $10,000 invested, you move the decimal places 4 places to the right. And that'll give you the amount of the fee you'll pay in cents. So 4 places would be 35 cents, $3.50. So $35 for every $10,000 invested. So it's a little more on the expensive side. Inception date, it's been about 10 years, just about a decade. So about 10 years it's been going. There are 67 companies in the fund. The price to earning ratio, PE ratio, is about almost 18, 17.8. The yield is about 2.36%. So the yield is not too great, not super high. The average price right now closed about $88. Okay, so that's a little about the fund. Let's look at the exposures. So in Noble, the two biggest sectors are going to be consumer staples, which is about 23%. So almost a quarter of it is going to be consumer staples. And that's going to be your companies that are making soap and dishwashers, or your Procter & Gamble, your Walmart, Target. Those are your staples, consumer staples. Your industrials, so that could be like your Caterpillar, your 3M, stuff like that. Right, that's almost half. Materials, normally in the S&P 500, ETF materials will be very low, like in the single digits, low single digits, 3, 4, 5%. Here, materials is represents 12%. Financial, usually higher in S&P 500, here about 11%. Healthcare, usually higher, about 18, 19, now about only 10.5%. And then it gets lower as you go down to consumer discretionary, real estate. So there's a little real estate exposure, 4%. Utilities and energy, all in the mid single digits. Information, energy, very low, 3.5%. Information technology, only 3%. Usually, information technology, your Apple and so on is usually 20%, right? So you see your exposure here is much less. Let's look at the top 10 index companies. And the reason why information technology is so small is because those companies usually have not, a lot of those companies have not been paying increasing dividends for 25 years. They're part of the S&P 500, but it's because a lot of them are newer to paying dividends, and that's the reason why. Top 10 index companies. And the index they follow is the S&P 500 dividend index, I believe. So the top 10 index companies would be ExxonMobil. These are all less than 2%. Aflac, Caterpillar, Emerson Electric, Chevron, AbbVie, Chubb Limited, General Dynamics. This is a company that makes, I think they make airplane and aerodynamic stuff. IBM. So not your typical top 10. There's no Amazon, there's no Google, there's no Apple, right? So it's a little different. It's mainly U.S. See, 94% U.S. United Kingdom and Switzerland and Ireland, very small, low 1%. Okay, let's look at the, I think of the return. So the inception is, it's been about 10 years, right? 2013, October 2013. So October 9th, 2013, that's when it opened. And it was 10,000 invested in October 9th, 2013. Now would be worth about $27,000. So almost triple, not quite. So the return over the last 1 year has been about 13%. Last 3 years, 9%. Over the last 5 years, 8%. And since inception, over the last 10 years, about 10.5%. S&P 500 Dividend Aristocrat Index. That's the index which it tracks. So it's pretty much mirror. 1 year, 13.64, 9.29, and it's tracking that index. So look at some of these other holdings. See, a lot of these holdings are names that you normally don't see. Stanley Black & Decker, W.W. Granger, S&P Global Inc., Ecolab, Federal Realty. So that's a real estate, that's a REIT, a real estate investment trust, 1.5%. Next are energy, that's utilities. Franklin Resources, I believe that is like an investment company. Smith, AO, Corporate Industrial, IBM. So some names that are not typically seen in other ETFs, Sherwin-Williams, Hormel Foods, Aflac. So these are S&P 500 and they're dividend aristocrats, so they've been raising their dividend for 25 years. Lowe's, Illinois Toolwork. So some names that are not popping out. McCormick, they make the spice. McDonald's, you know about McDonald's, 3M, General Parts, Target, right? We said the consumer staples are a large portion, 23%. So you have Target there. So some names that may not be jumping out. Okay, some names that may not be jumping out. Okay, let's look at the let's see if we can look at the so this is the index that we talk about, the S&P 500 Dividend Aristocrat Index. 67 companies. The PE ratio is about 19.5. The dividend yield is about 2.5. The average index market cap of the company about 84 billion. So big companies, and you have to be big to be in the S&P 500. Let's look at the returns. Let's look at the distributions. So the returns here in Seeking Alpha. So we say it's about $88 for one share of our NOBL ETF. The 52-week low has been about $83.86, and the high has been about $97. So we're in a low portion of the 52 week range. The expense ratio is about 0.35, which we said. The dividend it pays gets quarterly. I think it's on a 3, 6, 9, 12 pay rate. So you're getting paid your dividends or your distribution, they call them distribution for the ETF. March, June, September, and December. And dividend rate is about $1.94. Can be divided, that's a trailing 12 months. The yield they have here is 2.2%, very low. There's about $10.7 billion in assets under management in this ETF. So not a huge ETF. Let's look at now the dividend. The dividend 2.2%, not great, right? That's low. If you're looking to live up dividend, low twos, not great. You can get it in the S&P 500. Their dividend is paid about 1.6, 1.7. So not great. But the dividend growth here for the trailing 12 months, 9%. Dividend growth over the last 3 years, about 6.3%. Over the last 5 years, the dividend growth has been about 6.9%. They didn't give us a 10-year CAGR because at the time that this was recorded, I guess it must have been, or at the time this chart was done, it was before the 10th anniversary or before October 9th. So we don't have. So let's see what else we want to talk about. So this is showing the dividend growth. So initially when it began, it was paying like 13 cents. I'm not sure if this was I'm not sure if this is a quarterly. I'm not sure if that's quarterly. Let's go to the distribution. Let's go to distribution, see if we can find that. That might tell us. Okay, before we go to distribution, let's look at the growth of $10,000 since inception. The NOBL is in green, and the index it tracks is in blue. S&P 500 is in red. So the NOBL is in green, and the S&P 500 index it tracks. Obviously, they're going to be very close together. The S&P 500 is in orange. You're $10,000 if you had invested. Right now, it would be worth $32,000. So your money would have tripled in 10 years. Not bad. And your ending value in NOBL would be about $28,000, $29,000. So it's been tracking pretty good, tracking pretty close to the S&P 500. Let's look at, so we say the quarterly distribution. Let's see if we can find out how much they're paying in the distributions here. Yeah, I think this is annual. I think this is annual. I think this is annual. Yeah, I think this is annual. So you have to divide it by 4. So Okay, so what do we say about Noble? Um, it is solid companies. They have a track record. They've been paying dividends for at least 25 years. They're in the S&P 500. The dividend, so that's a criteria. The dividend yield, I would say, is not great, right? In the low 2.2% yield. The growth rate we see of the compound annual growth rate last 3 years about 6%, 5 years I guess it's about 8%. So the question is this something that someone would seriously consider if they're considering living off dividend? I would have to say probably not. I'm not excited about a dividend yield of 2%. The growth would have to be tremendous to overcome that low starting yield. But again, I'm just showing this to give you the different flavors that's out there. Again, you'd be diversified within the dividend aristocrats, but the dividend yield starting yield is low, and the growth is not that great. And there are other ETFs out there which can do a better job, such as SCHD. So we're probably going to say no to this one, but I want to give you the option, and obviously, you have to do your own due diligence. Again, guys, MD Investor, and we'll do other videos like this just to increase our financial IQ so we can teach our children and break the cycle of generational poverty. MD Investor out.